So welcome everybody to the next installment of the OurCrowd Teach-In Tuesday webinar series. This is an educational series we do twice a month on Tuesdays. I do recognize that it is Wednesdays. I'm your host, Zach Miller. This is a great one that we had tonight. We actually I think it is now officially the largest registration and attendance of any webinar we've done. We've had hundreds of people register for the event from around the world. So wherever you are, thank you for listening. Apologize also to our Australian listeners and investors. This is 2 o'clock in the morning there. We are recording the event tonight, so in case you'd like to share it with somebody or you don't have time to participate in the entire event, we will send out a link tomorrow, both with the slide deck and a recording as well. So before we get into the meat of the discussion tonight, just wanted to tell you who's going to be presenting tonight. I'm the older looking guy on the right-hand side. I'm a partner here at OurCrowd. I run the investor community. I'm Zach Miller. Joining me will be my partner in crime, David Stark, who's a partner on our investment team. And we're going to be talking about term sheets tonight. This is something we addressed early on when OurCrowd launched in 2012, and it's definitely something. It's an issue as angel investing is getting more and more popular. We've done almost 70 deals on our end. Term sheets come up in every deal that you encounter, and there's lots of different nuances here. So we wanted to take an interesting format. We normally do these sessions in an hour-long format. We're going to do it in 30 minutes. So we actually have a lot to cover. But by doing that, it means that we're going to have a three-part series. We had to push some stuff off. We'll send you a link to sign up for that as well. Tonight, we're going to be talking about the equity side. So if you're actually investing, you're buying a piece of a company, the next session that we'll have will be also about equity. And the third piece will have to do with convertible loans. And we'll deal with that. And we'll send you more information on that as we go. Who's OurCrowd? OurCrowd's a leading equity crowdfunding platform. We have over 8,000 investors who have registered for our platform. We have active investors from over 30 countries around the world. They're investing in some of the best Israeli and international startups. And so we have a lot of experience. And David Stark, my partner, who you'll hear from in just a bit, we see an incredible amount of deal flow, and I think you'll appreciate hearing his perspective as we've dealt with hundreds of term sheets over the past couple of years. So we'll jump in real quickly before I turn the reins over to David. At OurCrowd, we use a 6-point investment checklist. I'll run through them quickly. We've done other webinars on this topic. We can send out links to that as well. We look for a great team. We look for a market. We're looking for billion-dollar markets. We want investments that are easy to understand. This is something that came out of Warren Buffett. We'd like to see traction, right? We'd like to see initial product in the market, some early users, maybe some revenues. We'd like to see sponsorship. We'd like to see entrepreneurs that have built not just a good management team, but a good, surrounding themselves with good advisors, or a board. And lastly, and this is the most important part that for this webinar, we'd like to see a good deal. And so to talk about a good deal is a good segue into talking about term sheets. So from our point of view, we believe that angel investors should be looking for a deal that has a good risk-adjusted return, if you model that out, which affords for ample upside with downside protection. Obviously, this is easier said than done, and aligns interests. This is important. You don't have a zero-sum game. The more aggressive an investor is in terms of securing his piece of the pie, it may mean that the entrepreneurs are no longer incentivized. This is something we'll touch on in the webinar today. So that's it as a quick intro. Hopefully, if we do finish, there may be some time to take a question or two. If not, we can obviously answer your questions offline. So without further ado, let me introduce my partner, David Stark. David?
Thanks, Zach. So as Zach mentioned, the focus of tonight's webinar will really be about digging in and understanding the basics of a term sheet. Zach, go to the next slide, please. So what is a term sheet? A term sheet is a non-binding agreement setting forth the basic terms and conditions under which an investment will be made. So another name for a term sheet might be an LOI, or a letter of intent. Really the goal here is to make sure that you have the framework for an investment to be made, but you don't go through all of the nitty-gritty negotiation and working out all of the fine details, but you really establish what the key terms are going to be, and then you handle the rest of the details when you do the closing documents when the investment is being wired. But it's very important to point out, which is why we bolded this, that it's non-binding. And these terms are subject to change, and various things can occur between signing a term sheet and closing the investment that might alter the situation. So, as Zach mentioned, we're going to break down this series into 3 different lessons. The first 2 lessons are going to focus on equity term sheets. In today's discussion, we're going to talk about valuation, liquidation preferences, and employee stock option pools. In the second lesson, which is next Wednesday, we'll delve into preemptive rights, anti-dilution protection, board representation, and control provisions. And then lastly, 2 weeks from today, we'll really talk about convertible notes, which are a different investment structure entirely. What I would point out when you think about the various components of a term sheet is it really breaks down into 2 broad categories. The first is economics, and the second is control. So those are the 2 things that VCs really care about. Today's focus is going to be on the 3 most important terms as it pertains to the economic piece of the term sheet. So if there's one thing that you're going to take away from this webinar, it should be that valuation is just one component of the deal. And when considering the economics of the deal, it's a mistake to make that the sole focus. So valuation is definitely important, but valuation is very interconnected to liquidation preference and to ESOP, and they're actually just different sides of the same coin. And that's why we are encouraging and trying to educate investors in the way that we think about crafting deals, to not just focus on the sticker price of the valuation, but to really understand the holistic picture of the deal terms. So at a very basic level, when you hear people talk about valuation, valuation can mean one of 2 things. People refer to the pre-money valuation and the post-money valuation. The pre-money valuation is simply the valuation of the company prior to the investment, and the post-money valuation is the valuation of the company post-investment. So as you can see in the first formula, pre-money plus investment amount equals post-money. Now, if you want to calculate how much you're actually buying of the company, then what you're buying is you're buying the investment amount divided by the post-money equals your percent ownership. So it's important when thinking about investment amount to take into consideration not just your piece of the investment amount, but also what is the whole size of the investment amount in the round. That's what will determine the post-money. How do you arrive at valuation? This is actually a much broader topic that's out of the scope for today's discussion, but just to touch on it very briefly, we here at OurCrowd, and in general, it's best practice to use multiple methodologies. It's definitely a combination of an art and a science. When you're dealing with valuing early stage companies, you can't really run models that are based off of cash flow projections and comparables in the marketplace. You really have to factor in a lot of qualitative things like the quality of the team, the size of the market, the competitive landscape, the level of traction. All of those are important variables that go into determining a company's valuation. Zach and I actually discussed valuation methodologies in an earlier webinar, and there's a link at the bottom of this slide to be able to access that material. And when we distribute these slides after tonight's webinar, you'll be able to go and find those resources. So again, at a very high level, when you're thinking about valuation, this is the guiding framework. It's the company has certain objectives, and you have certain objectives. As Zach mentioned, your objectives are to have a good risk-adjusted return with ample upside, but also downside protection. So you know that you need to own a certain amount of this company for a certain investment amount. But at the same time, the company knows that in order for it to hit its milestones and objectives, it needs to raise a certain amount of capital, but it's sensitive to dilution and only wants to sell a certain percentage of its company. So given what the investor's objectives are and the founder's objectives are, if you can find some sort of overlap, which we refer to as the zone of possible agreement, then a deal can be made. If those circles do not overlap in any way, then it might mean that at this point in time, a deal is not in the works. It doesn't mean that a deal might not happen down the road at some point in the future, but it likely means that you're not going to get there at the moment. So this is a really interesting story, and what this is trying to highlight is kind of a trick of the trade, which is that the deal terms in the term sheet reflect the reality at the time that they're crafted. And what I mean by that is that there is a certain period of time before when the term sheet is signed and the investment is closed. This is usually something that is very clearly laid out in the term sheet, where you might have a 45, 60-day, 90-day period prior to closing. But for a company that is an early stage, fast growing company, that might mean that the underlying fundamentals of the business, that the key performance metrics are actually improving over the course of your final diligence stages, which are effectively making it an even more valuable deal than what you originally negotiated. So this is actually happening at the very moment with the deal that we're funding. So I just wanted to bring this as a real life case study. There's a company that we signed a term sheet with a couple months ago, and at the time, the quarterly revenue was $850,000, which equates to an annual run rate of $3.4 million. And the valuation multiple that we had negotiated was about a 6.5 times. We felt really good about that multiple because if you look at comparable transactions in the marketplace, the median transaction multiple is between 7 and 8. So we felt that 6.5 was definitely within the range, especially for a company that was growing so quickly. Now, what's really exciting about this deal is that since we signed that term sheet, quarterly revenue has now jumped to $1.35 million, putting it at a $5.4 million annual run rate and bringing that valuation multiple all the way down to 4.1x, effectively, giving us better value for our money. So shifting gears for a moment to the employee stock option plan. So what the employee stock option plan is it's a pool of shares that are used in order to attract and retain talent to the company. So these are options that are granted either to current management in order to make sure that they're still properly incentivized for the long run in building a large company, but they're also used that when recruiting senior management, you need to be able to give them an equity stake in order to convince them to come on board because they'll likely be taking a salary that's lower than what their market value is. These employee stock option plans grow and shrink over time as the ESOP is allocated and as the ESOP is then replenished later on. So you'd think that if the goal of the ESOP is in order to keep everyone highly motivated, that the bigger the better, right? And both the entrepreneurs and the company would want to maximize what the ESOP pool is. But in reality, that's not actually the case, because when we refer to pre-money valuation, we actually refer to a fully diluted pre-money valuation. And that factors in the employee stock option pool. Said in other words, if you want the pool to be larger, the current shareholders, including the founders, are going to have to bear the full weight of expanding that option pool rather than sharing it with the new investors if they were to make that pool larger at a later point in time. So founders typically in the negotiation want smaller ESOP, investors want larger. Now, how is this directly linked to valuation? It's linked to valuation because, as I said, it is factored into the pre-money pool. So here is a simplified mathematical example. So let's say that you've agreed with a company that you're going to invest at a $20 million pre-money valuation. The existing ESOP that hasn't been allocated yet is a 10% pool. But now let's say as the VC, you think to yourself, well, they really have key members of the team that they're going to need to recruit down the road. So we think that the proper amount of ESOP that they should have is 20%. Well, what you're going to insist on as the VC is that 10% is added to the ESOP pool on a pre-money basis. So if that 10% is coming out of the pre-money, so the effective valuation is actually $18 million as opposed to $20 million. So what happens in this scenario is that the investors will actually still at the end of the day own the same amount, but the existing shareholders are going to own less, and then there's going to be this unallocated piece that's going to go to future employees, okay? And what the investors, we as investors really like is that amount that's going to go to bring in those future employees is not something that we had to pay for, but the existing shareholders have to pay for. So that's why ESOP and valuation are inherently connected.
David, quick question before you move to the next slide. Dar asks, you mentioned evaluation as in terms of a multiple previously. What was that a multiple of?
Oh, great question. I should have clarified that. That was a multiple of revenue. So the numbers I was showing were revenue numbers. So it was a multiple of annual revenue.
Okay.
So in line with what I was just describing about how ESOP and valuation are connected, something to look out for, and this is, again, another real-world scenario that we have at the very moment with one of our portfolio companies. So our portfolio company has gotten an offer for a next round of financing from a top tier venture capital fund. And the offer, the valuation that they're offering them on a pre-money basis is higher than the valuation was on a post-money basis of our round. So if you just were to look at the sticker price of the valuation, you'd say to yourself, wow, this is great news. There's an uptick in the valuation. Things are going well. But in reality, what's happening is that the new investor is saying, well, the existing ESOP pool is not sufficient. We want you to allocate a significant amount of new ESOP, okay, which then expands the number of total outstanding shares and actually lowers the price per share. So despite there being a higher valuation number, the price per share that they're paying is actually lower, and it's effectively a down round. So that's why, again, it's important to think about ESOP as just being another lever as it pertains to valuation. And this is a trick that VCs like to play, and both we use to our advantage, but also that we have to look out for when it comes to our portfolio companies and future financings. Now moving to the third corner of the triangle is preferences. So liquidation preferences or distribution preferences are the ultimate downside protection. What a liquidation preference establishes is that the last money in is the first money out. So it doesn't necessarily always mean that the most senior class of preferred shares are the first ones to get paid out before the other preferred, but it definitely means that the preferred gets its money back before the common does. So we'll walk through a couple examples in order to understand how preferences work. So a lot of times when people refer to preferred shares, they conflate a lot of different concepts and think that they're all the same. But there's really three different types of liquidation preferences, and it's really important to pay attention to what type of preference is being discussed in your particular investment. So the scenario that we're going to carry through all of these examples is the following. We invest $1 million at a $4 million pre-money. Okay, based on the math that we discussed earlier, that would mean that the post-money valuation is $5 million. So if you wanted to figure out our ownership, that would be 1 million divided by 5 million. So we're buying 20% of the company. Okay. Now, let's say we were the last money that the company needed to raise. 6 months later, the company gets acquired for $10 million. Okay, that's our example. So the first type of preference is what's known as non-participating preferred. What non-participating preferred means is that you get the greater of your preference or your pro rata share of the company on an as if converted to common basis, okay? So let me explain that in simpler terms. So let's say that your preference is 1 times your money. So you're guaranteed that before anyone gets anything else, you're gonna get your money back, okay? But you also know that you own 20% of the company, so your piece of the pie is 20%. So what non-participating preferred means is that you'll get the greater of $1 million, which is the 1x preference, or 20% of the pie. And in this example, the pie ends up being $10 million, which is how much the company's acquired for. And as you can see, $1 million is less than the $2 million piece of the pie that you own. So your payout at the end of the day would be $2 million. So in this case, the fact that you had a preference doesn't even come into play, okay? Because it's as if you converted to common, you own the same type of stock as the founders and everyone else, and you just get your share. The next example is called participating preferred. In contrast to the previous example, which was the greater of your preference or your pro rata, in participating preferred, you get your preference and your pro rata. So, meaning you get your money back, and then you get your piece of the remaining distributable assets that the company has. So let's take our example again. You would get 1 million back, which is your investment amount, plus 20% times the remaining 9 million, which equals a total of 2.8 million. So compare that to the previous example where you got paid back $2 million. Now your upside return was really juiced by the fact that it was participating preferred, and you ended up with $2.8 million.
How common, David, is participating preferred?
Yeah, so it's a great question. Participating preferred is not very common. In fact, in certain instances, it's considered a somewhat onerous term, but it's really a function, as are all deal terms, are a function of the environment in which those terms are being negotiated. So it has a lot to do with who has the leverage. Does the investor have the leverage, or does the company have a leverage, which is a function of the supply and demand of capital within a particular market. The reason why I bring up kind of the market dynamics is that in Israel, for example, participating preferred is far more common than it is in the US. So in a lot of our US investments, we won't have participating preferred. We'll have non-participating, but in Israel, we may have participating preferred. And again, that's something to pay attention to. As you'll notice, the one on the preference is in brackets. The reason why that's in brackets is because that is another term of the negotiation. There's no rule that your preference has to be limited to 1 times your money back. It could be that you negotiate for a preference of 2x or 3x, and that could be a preference that exists under any of these scenarios. The last type of preferred shares is partial or capped participation. What this is it's like participating preferred, okay? But what it says is that you only get to participate up to a certain return. So if your return will exceed 3x or 5x, whatever that number is, then you get capped and you no longer get your preference, okay? So what instead would be the case is that you would convert to common so that you could actually get your piece of the pie, because your piece of the pie would actually end up yielding for you greater than what the capped preferred amount would be. So in this example, if you had, let's say, a cap on your participation of 5x, so in this case, because the company gets acquired for $10 million, it doesn't really matter, and it's the equivalent of participating preferred. But let's say that the company was acquired for anything more than $25 million, okay, which is 5 times what the valuation was when you invested. So then if you actually took your piece of the pie, you'd actually be able to make more than 5x. So you'd rather be common and get your piece of the pie than get this preference. So you'd give up the preference and you'd be treated like non-participating preferred. So there are clear trade-offs between valuation and preferences. So again, the focus of this kind of webinar is to say, if you look at valuation in a vacuum, then you're missing a really important part of the story. So liquidation preferences can actually create these kind of zones of indifference towards certain exit scenarios. And I'll explain what I mean with an example.
Before we do that, can we ask a quick question that came in?
Sure.
Okay. Jonathan asks, what's the benefit of a VC going with a preferred cap structure?
So a preferred cap structure is really considered kind of a compromise between participating preferred and non-participating preferred. So what you're telling the company is, hey, I'm not in this just to get my 1x money back, okay? I want to be able to get my 1x plus my piece of the pie. But if this ends up being a really great outcome, I'm not going to be greedy and insist on double dipping where I get my money back and then I also get my piece of the pie. So it's really a compromise.
Great. So let's move on to that example you described.
Okay, here's a real life case study about how valuation and preferences are very much linked. We're currently investing in a company at an $110 million pre-money valuation, okay? And that is illustrated in scenario B here. So the way that the case works is that the total round is $15 million going in at $110 million pre-money valuation. The post-money, as you can see, is $125 million. The ownership of our series of stock will be 12%, okay? And here's where things get interesting. The preference amount is 2x, okay? So this scenario is at 2x, non-participating preferred. And this is a real-life case study. Now, what I want to illustrate is I want to contrast that with a different scenario. Scenario A is, let's say for the same deal, we had negotiated with them that the pre-money valuation would be $60 million pre-money, okay? Same amount of money going in, but because the post-money is now 75, we actually would own 20% instead of 12%, okay? But in this case, let's say we would have to forfeit the 2x preference, and instead we'd only get a 1x preference, okay? So that then translates to the bottom row in both of these scenarios where you can see what the preference amount is. In scenario A, the preference amount is $15 million, and scenario B is $30 million. Now, what I think is so fascinating and really is a matter of what your style is as an investor and kind of what your risk tolerance is, how you think about risk mitigation versus upside. I'm not going to tell you that there's a clear answer as to which one is better, okay? But if you look at the table, what I illustrated was a number of outcomes here. So let's say things go terribly wrong and the company is able to liquidate its assets for $15 million, okay? In that case, both scenario A and scenario B, they get back their $15 million. I mean, that's all the company has. It's as if you own 100% of the company and you get your money back, okay? But the moment that the company makes $1 more than $15 million, okay, as illustrated by the $30 million scenario, then that money, okay, goes to scenario B. So scenario B, they get the first $30 million out of the company no matter what happens in the event of a liquidation, okay? So if the company had to sell for $30 million, guess what? Scenario B, even though they invested at a $110 million pre-money valuation, they still double their money. Whereas scenario A, they get their money back. They do recover their money. Now move that to $75 million, same thing. Scenario B gets double their money. Scenario A still just gets back their money. The break-even point here is at $150 million, where both scenario A and B generate 2 times their money, okay? Post that break-even point, as you'll see here, scenario A does make more than scenario B because they're in at a lower basis, okay? So the question you have to ask yourself, and this is an exercise that we do all the time, is the additional upside that you get from scenario A, okay, does it sufficiently compensate you for the better outcome that you get all throughout the downside scenarios? So as we illustrated, any outcome between $16 million and $149 million, scenario B is better off. Any outcome between $151 million and up, scenario A is better off. So the question is, how do you view risk mitigation versus upside? And the two, again, I think this illustrates that preferences and valuation, you need to look at them together in order to really understand the full picture. So with that, I think exactly on time.
Wow.
That was pretty amazing. We end today's session, and we want to invite you to join us next week for lesson 2, where we'll be talking about anti-dilution protection, board representation, as well as control provisions. We'll maybe throw in a couple other surprises. We hope you join us. We'd love to hear your feedback. We'd love any questions that you might have, things you'd like us to address in future classes. We want to be doing more and more of these. Thank you so much. Zach?
Yeah, and as you can see on the right-hand side, if you are an accredited investor, you can definitely log in or sign up at OurCrowd.com. You'll see the opportunities that we have there, some of which we drew from, David so adeptly drew from in some of his examples. The term sheets are there if you want to review them. We have about 4 to 6 opportunities available at any time. We couldn't necessarily name them by name, but if you log in, you'll be able to see the real-life opportunities that we're investing in today. Thank you for your time. I know you guys are busy, and we always appreciate the time you give to us. Thanks, guys, and we'll speak again next week.